Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 95th episode, Dividend Paying Stocks. Okay, so we are still respecting social distancing, and this week Corey's working away in the office, so I decided just to pop in the studio to record the show solo again. If you'd like to have Corey back on the show, let me know. We'd love to have him back as well, so we'll probably maybe do a Zoom video chat for our next one, or we'll see down the road here. Before I dive into today's topic, of course, I hope that everyone out there is staying healthy and safe. Certainly been some interesting times with the horrible pandemic and then also dealing with the horrible tragedy in Minnesota. So again, hope everybody's family is staying healthy and safe and realizing that this too shall pass, and we'll just stay persistent, vigilant, and careful out there. For today's topic on the show, I wanted to talk about dividend paying stocks. To us, we think it's a very useful position in a portfolio, and I don't think a lot of individual investors understand them. So first, I wanted just to define what a dividend is. And so, in prior shows, I've talked about what a stock is, which is just an ownership stake in a publicly traded company. And a dividend is what a company will do typically to attract shareholders. And so what they'll do is they'll normally announce a quarterly dividend, and they're basically rewarding or paying back owners of the shares for investing in their company. And this is great for investors to get some sort of return on your investment. It's kind of like being a business owner and taking an income distribution from the company, right? And that's why a lot of people are in business for themselves, so that they can reap benefits or rewards from owning their own business. So that's the same idea behind a dividend. I think a big misconception, though, for a lot of people is that they don't understand is that a dividend also affects the share price. And let me give you an example. So if a company is priced at $100 per share and they announce a 15-cent dividend quarterly, well, the projection then for that company would be to pay their shareholders $60 cents a year. So 15 cents every quarter. So that'd be 15 cents, 15 cents, 15 cents, and 50 cents. So 60 cents in a year. I was compounding my math too quickly there. And every time they pay this dividend, though, the stock will go down by 15 cents. So if they're going to pay a dividend on July 1st and the stock's trading at $100, when the dividend gets paid, that stock price is going to drop to $99.85. Okay, so it's you don't get your cake and eat it too. So in your account, if you had one share of this stock and that paid a dividend and the stock price didn't move, the value of your account would still be $100, right? Because you'd still have the one share valued at $99.85, and you would still have, and now you'd have 15 cents sitting in cash. Now, of course, you could reinvest that back into the stock, or you could just keep the cash or take the cash out. So the whole idea behind dividends is that, yes, you get paid as the investor. You understand that the stock price is going to be negatively impacted by that dividend, but the anticipation is that that company will continue to do well and the stock price will recover and grow after the dividend is paid. Okay, so that's what a dividend is in there. Now, why do we invest in dividend-paying stocks? Well, the reason we typically invest in dividend-paying stocks is that we like the income that is generated. Meaning, in my example here, so if you own one share of ABC company or whatever it is, and they pay you a dividend, you can now, especially as a retiree, go and spend that dividend without having to sell shares. So that's why we really, really like dividends. And even for somebody younger saving in retirement, there's nothing saying you can't spend that money if you need it, or reinvest that money and just accumulate more shares or buy back into something else, right? So for the retiree, we like the income generation. That's huge. For the younger saver, we like being able to reinvest that money in something else or right back into the company that paid the dividend. Okay, so that's why we invest in them for our clients. Now, a lot of people want to know how they go about investing in dividends. And to us, the most transparent, cost-effective, simplistic way is to literally go and buy the stocks for our clients. A lot of other advisors will use products to get dividend exposure, which we disagree with. We do not like that. Again, this is our opinion, but we don't see the reason to go pay a mutual fund fee to go buy dividend paying stocks when we can just go literally do that ourselves for our clients. Or even buy an exchange traded fund, which again still charges fees, or can charge fees certainly, but also has no management. So you might not, and I'll give you an example. So here recently during the pandemic, not a lot, but enough companies have cut their dividends, right? So they've said, look, we're just trying to keep our business afloat. We know we've paid a dividend in the past. We're not going to be able to do so this year. Well, if you're in an exchange traded fund that's comprised and that you think is supposed to pay dividends, well, if you still own that exchange traded fund, it still probably owns the stocks that are no longer paying dividends, which will hurt your income. Here at Falcon Wealth Advisors, if a company cuts their dividend, we can move out of that stock and go buy another stock or company that still pays a dividend, right? So we're actively managing that for our clients versus just riding a passive index. So we don't like the mutual funds because of the fees. We think that we can do that. We can cut out the middleman. And we don't like the index fund because there's nobody driving the boat there on that. So in our opinion, the most efficient, again, this is my opinion, this is the way we do things at Falcon Wealth Advisors, the most efficient way to get into dividend stocks is to literally just go buy stocks that pay their dividends. So you say, okay, Jake, I get it. I get dividend paying stocks, but how do you know which stock to buy? Which strategy do you use? And there's a lot that goes into it, but what we like from our standpoint is we like a company that has a strong history of increasing their dividend over time. And the reason we like that is that when we buy a stock, we don't want to be having to day trade it or get in and out of it. And the idea is that if a company's raising their dividend, that's normally, not always, that's normally a good sign that the dividend is healthy, meaning they might not have to cut it if things get bad. And also that income stream that our clients are living off of is going to increase, hopefully, with inflation, right? So a dollar today is not going to be worth the same as a dollar 30 years from now, more than likely. And so that's why we like companies that have a strong history of increasing their dividends. We also use Bloomberg, which is, in my opinion, one of the premier research platforms out there. And they actually have an indicator that will rate the health of a dividend for a certain company. So we'll take that into consideration as well. We'll certainly look at yield, right? We like to get typically dividends that are paying over 2%. Not always the case, but we like that when we're looking at dividends as well. So there's several factors that go into it, but we really like companies that, again, have a strong history of increasing their dividend. That's really, we really like that about dividend paying stocks. We don't think the entire portfolio should necessarily be comprised of dividend paying stocks. We're actually experimenting with that right now. So stay tuned on that. We may be rolling out a dividend only portfolio, but for our clients today, most all of them have a combination of dividend and growth stocks. The difference there on a growth stock is that they don't pay dividends, but the idea is that the company will become worth more over time. And so for our clients' portfolios, we're looking to get a combination of growth and income. But some clients might say, hey, Jake, I just want income. I don't care about growth. And that hasn't been very common, but that's why we're experimenting with it and looking at potentially rolling out a different portfolio for the retiree that cares more about capital preservation versus asset accumulation or growth in there. So stay tuned on that. But for today's purposes, we like a combination of both. We think it makes sense to have growth and income. We've got about half of our portfolio of stocks and income paying stocks that pay dividends, and then we monitor it and we go direct. So hopefully you've pulled some information out of today's show regarding dividend paying stocks. I think they're great. It's fascinating. It's pretty awesome. A lot of companies out there that have been able to increase their dividend or maintain their dividend over these horrible times. It just shows you what kind of shape businesses are really in, which is pretty interesting things in there. Certainly, if you have any questions or any show topics down the line, you can reach out to us on all the social media platforms. Here's a quick plug. I'm out there on Instagram, Twitter, LinkedIn, and Facebook. If you're watching this on YouTube, thank you so much. Our subscriber count continues to grow, so thank you. We appreciate a thumbs up. Or if you're listening to this on your favorite podcast platform, of course, we thank you for tuning in and hope that you're finding value out of our shows. For my fun topics today, I always like to talk about maybe things that I'm doing outside the office. There's a really good show that Rachel and I have been watching called Space Force. It's got Steve Carell in it from The Office. It's kind of a funny spoof on space exploration from a military standpoint. It's on Netflix. You can binge watch it. We haven't watched all of it yet, but it's been a pretty funny show that we've both enjoyed together. I've recently finished a good book on Jim Simons. I think it's titled The Man That Figured Out the Stock Market. It's about one of the best hedge fund managers of all time. Very fascinating. And I'm currently reading Ray Dalio's big book. That thing's like a dictionary, called Principles. He's another hedge fund manager that has a good track record, and he's just lived a very awesome life. And he's got some really good tips in there on how to manage your own personal principles as well as when you're running a company. So I'm finding a lot of fun reading that book right now. Been playing a lot of golf. Hanging out with Rachel, doing whatever she says around the house. So again, we hope all of you are staying healthy and safe. Hopefully you're getting out and enjoying some of this warm weather in Kansas City if you are local. And again, of course, we wish that all of you stay safe and healthy and have a great week.